Consumer sentiment in the U.S. is sliding to near historic lows as Americans grow increasingly frustrated with the economy. But don't tell that to stock traders. The S&P 500 has hit 4 record highs this month. So why is Wall Street so upbeat when many Americans feel like the economy is lousy? Let's get some answers and break down the numbers with CNN senior reporter Matt Egan and CNN chief data analyst Harry Enton. All right, Matt, to you first. What's going on here?
Yeah, Brianna, look, the mood on Wall Street has been unbelievably positive and optimistic. The stock market has taken off basically like a rocket ship ever since the president paused those Liberation Day tariffs. The S&P 500 has added almost $14 trillion in value just since those April 8th lows. It's been a stunning increase in value in a short amount of time. And the Nasdaq is on track for its 6th consecutive record high today. Now, that's because investors are really fired up about the Federal Reserve. Interest rate cuts, they tend to boost stock prices. They make stocks look more attractive than bonds. They can boost the economy. And so that's what investors are focused on. But the mood on Main Street is anything but euphoric. We learned on Friday that consumer sentiment fell again this month. I like to look at independents because we know there is some partisan divide in those numbers. And, independents at this point of President Trump's first term, they were feeling really good. But consumer sentiment is almost half of where it was at that point. And what's been incredible is that investors have been totally unfazed by signs of trouble in the real economy. Sure, hiring has slowed to almost a halt and unemployment has started to tick up and inflation is at a 7-month high, but investors, they're focused more on better than expected corporate profitability. They are loving the AI boom that has boosted NVIDIA and Oracle and so many other companies. And yes, they're focused on the Federal Reserve. Investors are increasingly confident the Fed is going to cut not just this week, but in a series of cuts in the coming months. Of course, the Fed is not cutting interest rates because inflation has been defeated, right? It hasn't. The Fed is cutting interest rates because they're trying to shore up the job market. And veteran market strategist Art Hogan, he told me that celebrating the Fed coming to the rescue.
Sorry, you guys, I just want him to get through his point before I start giving my opinion on this. Let me let him go ahead and finish.
Is kind of like celebrating an ambulance arriving to your house early until you think about why you needed an ambulance in the first place. So, Brianna, that's where we are right now. A lot of focus on when the Fed is going to cut and by how much, a lot less focus on why.
All right, Harry, tell us.
Okay, before we get there, this is a very, very interesting story because this is the tale of two economies, right? You have the stock market, which is they just had record numbers again. And first off, I just think not the economy, but stocks. I think at this point, the stock market is too big to fail. Now that sounds crazy because I recall the .com era. I recall but even still, a lot of people made money. A lot of people didn't. A lot of people lost money. I remember, was it Pacific Bell? The other one that just went belly up. A lot of people got hurt in that one. And there were some other big booms and busts in the economy. But in the stock market, at this point, I think that you have a lot of people who are investors who are just making just gobs of money. Then you have, we'll say that's the 20%, right? The 20% are, because I read this article a while ago that says 20% of people, or the wealthy, are supporting the economy essentially. And the other 80% are the people that normal, everyday people, you and I, who are just out here trying to make it. So in a sense, they're catering to 20% of the population that are spending money on, the services and keeping, the economy going. Whereas we'll just say the 80%, that's the everyday person, average Joe, not bad. I was just saying, like, most of us don't have a lot of discretionary income. Most of us are raising families and doing all this type of stuff. Um, and then you tack on a lot of the student debts along with that. But this is very, very interesting. Let's let this go a little bit longer, and I want to see what they have to say. But I think this is, again, your classic tale of two economies.
Tell us more about what Americans are feeling about the economy and what they believe is important, because it sure isn't what investors think is important.
No, and
See,
that talk of
investor.
ambulance just reminded me a few minutes ago. I got a call. Apparently, my LDL is up through the roof, so I might need that ambulance. Anyway, what are we talking about here? U.S. economy is getting worse. This trend line is no bueno. In November of 2024, when Donald Trump was reelected, was 42%. Look at where we are now, up to 56%. The clear majority of Americans believe that the economy is getting worse. Less than a third think that the economy is getting better. This is a very, very troubling trend line. And of course, as Matt was talking about, what are the top concerns for Americans at this particular point? The top issue for you right now, hello, what's number one on your list? It's inflation. It's 34%. The economy, 16%. You add the two of those together, that is a majority, 50% of the American public who say either inflation or the economy is the top issue for them right now. Nowhere on here do I see the stock market, because obviously the stock market's doing pretty gosh darn well at this point.
Well, how many people own stocks?
Yeah, okay, I think this is sort of the big giveaway here, right? You know, this is what we're talking about. If the stock market was the economy, then everyone would be smiles and everyone would be fantastic. But here's, I think, the thing that's so important to note. American families who own stock, any stock, including indirectly, that's 58%. Of course, we're talking ETFs, mutual funds, retirement accounts, et cetera. But directly, the folks who really probably are keeping their eye on the stock market every single day, that's only 21% of American families. So the stock market doesn't equal the economy. Yes, the two of them are oftentimes tied up together. There's certainly some correlation going on here. But when we're talking just a fifth of Americans who own stock directly, no wonder there is this massive, huge, wide open gap between what the stock market is doing and those who are involved in the stock market daily and what the American families are doing, because at this point, they're just swimming in totally different directions.
I promise you, I did not watch this video before I decided to react to it. It just caught me. This is exactly what I was saying. You have 20% of the economy, 20%, yeah, 20% of the population driving the economy, basically. And that is the wealthy people. And a lot of those, not a lot, we'll say some, is obviously your retirees, a lot of the boomer generation are driving a lot of that. Not a bad, a lot of them earned it. Not here to have a generational debate or anything like that. Just calling it how I see it. Trying to call balls and strikes very fair. And you have 20%, and you got 80% of the economy that is falling behind. And it's not going to get better. So then you ask yourself, then what happens if they lower interest rates? Well, it's a good question. That 20% of the population now then has more of an opportunity to grow even more wealth, right? Because they're not strapped, more than likely, they're not strapped with student loans. More than likely, they're not, they don't have a lot of consumer debt. So it's just gonna, more likely they own real estate, which then is going to allow them to access more capital potentially by doing a cash out refinance and pulling some equity out and going buy more assets to then further drive this wealth gap. So again, if companies only need 20% of their of the population, we're just talking US, to drive sales, they're going to cater to those people. They're not going to cater to the 80%. It's just a good business move. I would look at it as you can work it, and this is not either or, one's bad and one's good. I'm just saying, for example's sake, I had a friend who worked for the BMW dealership. He wouldn't have to sell a high volume number of cars to make money. You maybe sell a few a month, but made a fortune. This is back in like the early 2000s, of course. And then you talk to people that are working at Honda dealership or something like that. Not a shot against Honda. I have a Honda. Um, the volume they would have to sell a lot more to get those types of numbers. So I'm saying it's logical to cater to trying to service less people and still make record profits versus having this cater to the majority of people and have a higher volume. And you know, I hope I'm making sense here. I'm trying to really mine this out as best I can, but essentially they don't need 80%. I hate to be so blunt about it, but that's kind of what I'm seeing, and that's how I'm choosing to interpret this. But you guys maybe beat it up in the comments and let me know if you guys think that if I'm, if you guys feel the same way or you're seeing the same thing. But essentially, you got two economies. You have the everyday working person, and then you have the 20% who are just investors. And I'm not saying one's bad or one's good. I'm just saying I think at this point you need to figure out which side you want to be on. Because like you said, they're swimming further and further apart from each other. And I agree because I'm seeing it. So let me know what you guys think in the comments. I'm going to leave a link to the description in this video. I'm going to leave a link in the description to the video. Yeah, very fascinating times. And yeah, a lot of things happening. Don't forget to like, comment, subscribe, and share. I'll see you guys in the next one.